Gold starts to get comfortable above 2,000 and tech receives heavyweight support. You're listening to Kitco Roundtable. I'm your host, Michael McCrae. We have with us our favorite battery metals expert. It's Matt Fernley with Battery Materials Review. Matt, how are you?
Good, thanks. Thanks very much for having me on again.
Matt, there is a lot to catch up on. You're an expert on all things battery metals upstream. But before we begin, do you have a favorite electric car?
I've got lots of favorites. None of them I can afford, unfortunately. But I would have to say, probably as listeners to my podcast would know, I have a soft spot for the Wulin Hongguan Mini EV in China. But in Europe, probably the closest to my price range is something like the Dacia Spring.
I was, that is a good response and terribly detailed. I've been in very few electric cars. As much as I kind of admire the space, I can't say I'm a fan of cars because every time I'm doing them, it seems like I'm doing some type of work trying to get from here to there. Let's turn to macro. Gold repeated last week's move, a stumble into the 1990s after enjoying a stretch in the 2000s. This week, gold dropped on Friday due to partly stronger than expected manufacturing service sector data. Friday, the S&P Global Flash US Manufacturing PMI data rose 50.4, up from March's reading of 49.2. According to consensus estimates, economists were expecting a relatively unchanged reading. A PMI above 50, which we did get as a data point, says that there's improving economic conditions, whereas 50 below is deteriorating. So bottom line, this one data point shows the economy is stronger than expected, so the Fed can tighten to fight inflation. As of noon Eastern Time, gold was at 1997 and silver at the 25 level. Last week saw the same pattern, profit taking and some strong economic data knocking gold off its $2,000 perch. Still, gold has spent a lot of time above 2,000. Dave Earthley writes that there is just one more hurdle that is needed before gold gets comfortable at this $2,000 level. A monthly close above the psychological number may be required beforehand. In other metals news, mixed data from China sent copper lower than any of the week at around the $4 a pound level. Oil was softer too, with WTI in the high 70s. In mining news, the Teck Glencore saga continues. Earlier this month, Glencore made an unsolicited bid for Teck. Teck has been lining up support for its independence, mostly around the theme of national protection of its ownership of critical metals like copper and zinc. BC Premier David Eby says that the provincial government doesn't have the legal authority to block the takeover of BC's Teck resources, but will be lobbying the federal government to do what it can to prevent it. That, according to reporting by Business in Vancouver. The Financial Times also said that Justin Trudeau's senior cabinet ministers are keeping a close eye on the deal and like having a large miner headquartered in Canada. And mining magnate Robert Friedland had his own views, which he said in a Twitter thread, quote, "I would caution we should not lightly sacrifice such a champion at the altar of short-term gain, losing another quintessential Canadian support mechanism to multinationals to corporatize and hollow out our unique ecosystem that has so successfully explored our vast landmass." Matt, back to you. I'm glad to have you back. We had you in January, but it just seems that there has been so many headlines in the battery metal space. We just need you to catch up. There's a lot of conflicting news too in the battery metal space. I feel that you can grab one headline or another, and then you can have your thesis, whether it's bullish or it is bearish. Let's start with the naysayers. Chinese spot market for battery grade lithium carbonate prices have more than halved this year. That according to Benchmark Minerals. Matt, is this it for lithium bulls?
No, totally not. It is just a reasonable cyclical downturn within a super cycle. So if you look at the super cycle for copper in sort of 2002 to 2012, prices went up very rapidly and then they were cyclical around a higher average level. And that's exactly what we're seeing in lithium. So prices went up to sort of $80 a kilo. They've come off by sort of 50 or 60%. And we expect prices to be cyclical, but at a higher average level over the next 5 or 6 years. So, the average could be anywhere between sort of 50 and $60 a kilo. My personal view is that I believe that lithium prices will bounce in the very near term. We're already below the marginal cost of production for a number of assets in China. We already started to see production cuts in lepidolite conversion supply and spodumene conversion supply in March, and I think that that's going to continue in April. And I believe that probably lithium prices will pick up over the next couple of months. So, yeah, I'm not too worried about lithium in the near term. I think there's enough supply demand deficit that lithium prices will bounce, and this is not the end for lithium.
Is this still though, Matt? Is it sticking with the lithium prices for a minute? I believe this still is a pretty good lithium price right now, correct?
Oh yes, I mean compared to where we were sort of in 2019, 2020, this is a great lithium price, and the spodumene miners in Western Australia, the brine processors in Latin America are making pretty reasonable margins at these prices. It's really just the non-integrated converters in China that are struggling. But I think the thing to be aware of that is that the thing that's very different to 2018, where of course we saw that very substantial lithium price correction as well. The thing that's different to 2018 is we've got this substantial demand event here. And as you have a substantial demand event, you're adding on capacity at the right hand side of the cost curve, which is higher cost capacity. So it's pulling your cost curve to the right, but it's also pulling your cost curve up. And I think that's what a lot of people looking at the industry don't really understand, that the marginal cost of production in 2018 is totally different to the marginal cost of production now, and indeed will be different from the marginal cost of production in 5 years' time. So I don't expect lithium prices to really ever go back to the sort of levels they are at in 2019, 2020, because most of the marginal assets that are in production now wouldn't be able to operate. And indeed, the marginal assets that are going to go on over the next 2 or 3 years, again, wouldn't be able to operate. So I think, that's the industry that we're looking at now is very, very different to the industry that we saw sort of pre 2018.
Point
And I
two,
think the
Matt.
other thing,
How?
just sorry, and I think the other thing just to be aware of is that a lot of people are very worried about the huge increase in lepidolite capacity that's going on in China. And I think the fall in prices that we've experienced may weed out some of that marginal capacity that would have gone on. It may now not go on because the prolonged price downturn will show potential producers that it's not really a free ride in lithium. So, in many ways, what's happening now in the industry from a pricing point of view is actually positive for later on. And then, news that's broken over the last couple of days in terms of what's happening in Chile with regards to the potential nationalization of the industry, certainly of new development projects. Again, that has the potential to push out the market because it will potentially put smaller companies off from investing in Chile if it's not handled correctly. So, all of this is positive for the mining side of the industry, not great for the EV side of the industry.
Point number two from the naysayers, Matt, that would be substitution. CATL, the world's biggest maker of EV batteries, said its first sodium-ion battery would power electric vehicles built by a major Chinese brand, Cherry. What is sodium-ion batteries, and should lithium-ion battery makers be worried?
Yeah, we actually did a very big focus article on sodium-ion batteries in the last issue of Battery Materials Review, and I went into it with the concern that it would be quite difficult for the sodium-ion supply chain to ramp up capacity. One of the factors that everybody points to with regards to sodium-ion is, of course, sodium is 10 times more abundant in the Earth's crust than lithium is. But the problem is it's actually getting pure enough sodium, sodium hydroxide or sodium carbonate to use in your batteries. And on top of that, there's other elements of the supply chain. So sodium is just one element of the cathode. There's different elements of the cathode materials and then the anode materials. which actually may be quite difficult to ramp up supply of. So it's not confirmed that sodium ion is going to always be, I think, a third cheaper as it is at the moment than lithium ion. And the issue with sodium ion at the moment is energy density. So most people talk about sodium ion being used in stationary storage and in two-wheelers. We did a scenario analysis and that in Battery Materials Review, and came out with some quite interesting numbers in terms of the requirement to upscale the supply chain. And of course, if that did happen, it would offset a little bit of lithium demand, which actually might be a positive because the magnitude of the supply demand gap at the end of the 2030s for lithium is quite substantial at the moment, and I don't think it's in anybody's interests for prices to go so high that we start to see demand destruction as we did in copper in sort of 2007, 2008, 2009. So, you know, I am aware that people are worried about sodium ion. I think there is a risk of substitution in low end electric vehicles and certainly in energy stationary storage. But at this point, we're not seeing it as a major concern. And I don't think it's ever going to compete with high nickel batteries for premium and mid market vehicles. It's really only going to be in the two wheelers, the three wheelers, and potentially the mini EVs where it's going to compete. And of course, mini EVs aren't really sold outside China. So at the moment, we are monitoring it, and we're not concerned from a lithium point of view. But obviously, it does present other interesting areas to invest from a sodium ion point of view. So we're keeping a very close eye on that as well.
How about falling demand, Matt? Tesla stock has tumbled 10% this week when it committed to further price cuts to drive up demand.
I mean, we were aware, we were forecasting that EV sales growth this year would be slower than last year. We obviously had the first taste of that was in Europe with the energy crisis last year, and we saw a big slowdown in EV sales growth in Europe. With interest rates going up, we were aware that that would impact car demand, probably in the US, where obviously a lot of cars, not just EVs, are sold in credit. So, we had a slowdown in rate of growth factored into our forecasts. We're expecting something like 25 to 30% year on year growth in EV demand this year. That is pretty much where we are at the moment. And there are signs that China may actually start to accelerate. So, pretty happy with where my sales forecasts are now. In terms of the price war in electric vehicles, I think it's coming back again to this thing that we've touched on many times in the past, that at the moment EVs are just too expensive, and we need EV prices to come down if we're going to hit mass market in electric vehicles. I've done this analysis for Europe that the median price for electric vehicles in Europe is about 30 to 35,000 pounds. The median price for ICEs is about 15,000 pounds. So we just need electric vehicles to come down in price. And I think these price wars, while potentially painful for the OEMs, are potentially quite positive for from the point of view of raw materials demand.
Matt, I always wonder how much that the critical metal space is supported by government subsidies and government policy direction. Just because in the U.S. has just been a real giant with its Inflation Reduction Act that was introduced by Biden during the summer of 2022. And it seems like everything around ESG has just become a lightning rod for right-leaning states. You see that there's been disinvestment, or how would you say, a disfavor of ESG related funds. You see that Speaker McCarthy wants to see partially IRA repeal. If you see that there is more government support, if there's more right-leaning government support, if some of these policies or some of these supports start coming away, how much could that impact critical metals?
I mean, I think it will because obviously the US market is a big market, and for electric vehicles for stationary storage. And if we do see, a lower level of support in the US market, that will impact demand in the medium term. I think in the longer term, I'm not too worried because I do think that once electric vehicles and stationary storage builds up a critical mass, um, it will be all right. And in fact, on the stationary storage side, I'm not really worried at all, because effectively the support for stationary storage is coming from private entities and from states. So it's not really from the federal government at this stage. And over the next sort of 15 or 20 years, stationary storage will be a larger driver of battery demand than EVs will, in the long run. On the EV space, obviously, it is helpful to have the federal support in terms of the tax credits on electric vehicles. And I think that the IRA has been enormously successful in terms of bringing manufacturing capacity back to North America. And I can't think that any government would want to unwind that because you're generating jobs basically in North America off the back of that act. So I think it might impact future investments, but I can't see them unwinding current investments, as it were. And obviously, if Volkswagen or Northvolt or LG Energy Solutions or Ford or GM makes an investment in a battery factory, they've presumably negotiated a long-term sort of fiscal regime, and I think it would be very, very difficult for any government to turn their back on those long-term terms. So, my gut feeling is I'm pretty happy with what the IRA has already done in terms of moving manufacturing investment into the US in the battery supply chain. Um, the big question is what it does then in the medium term if there's a change of government in the US. But so in the short term, I'm not worried. In the medium term, I'm slightly worried. In the long term, I'm not worried because I think we are nearing that level of critical mass. Um, but I must say, it's very interesting looking into the US from outside, in terms of how much of a pushback there has been against sort of ESG and thematics concerned with ESG.
Matt, I want to turn to the junior sector in a minute because we see a lot of investment coming into the space, a lot of junior miners that are coming in and then looking at investments and doing exploration. And you've had a big study on that. But before we get there, it's only April right now in 2023, late April. What has been the major development? What has been kind of the key milestone in the battery metal space in 2023?
Well, I mean, we've covered a lot of them. Obviously, the collapse in lithium prices has been quite a big move, and that certainly consumed a lot of column inches. Sodium ion, we've talked about, and also the IRA and the release by the Biden government in terms of the details regarding the battery supply chain and what counted in terms of the supply chain over the last couple of weeks was pretty relevant as well. So all of those three factors, I'd say, are the big sort of movers and shakers in the battery material space at the moment. Obviously, there's some really interesting exploration going on around the world as well, which continues to get some great column inches. But I would say those are the primary areas.
I think my surprise was, and it's just kind of going back to the question that we talked about earlier, support for ESG. It just seems like how quickly all of that money was deployed. There was, you saw the deal that happened with Jervois, you saw the deal that happened with Piedmont, you see the deal that happened with Linus, and I know that I'm missing a lot of other ones as well, but it just seems like the investment was made in manufacturing. The investment was made in downstream processing quite quickly, just after the announcement in 2022. It was, I don't know, did they have these studies floating around? Were they ready? They knew that something was coming?
Well, I mean, I think this is one of the areas where the US really differentiates itself from Europe in terms of its approach. And, there's no doubt that the US has benefited from the IRA in a way that Europe really hasn't, and we're starting to see European, manufacturing businesses looking to resite their operations into the US. So, excuse me. So I think that when I had the singular joy 3 or 4 weeks ago of reading through all 94 pages of the European Critical Raw Materials Act and the European Zero Carbon Industry Act, and compared to what the US is offering, Europe is nowhere. It's offering greater regulation, more box ticking, more levels of bureaucracy, compared to the US, which is genuinely, offering the carrot rather than the stick. And I can understand why everybody is very keen to lock that in. So, um, I once you've got a battery factory, you can pretty much build it in any region apart from the specific local issues. So I wasn't surprised to see them, and of course the money that's come into the raw materials industry, that's for applications that were made sort of in the middle of last year. So I wasn't. I mean, I wasn't surprised, but I have been pleased with the rapidity of the amount of money that's being deployed into the sort of midstream part of the industry. We obviously still need to see improvements with regards to planning in the upstream part of the industry, which is a real bottleneck at the moment, not only in the US but in many regions. But it's great to see large amounts of capital being deployed because, of course, last year was a really difficult year for the industry in terms of raising money because equity markets were so weak. And in fact, funds raised in the lithium space was down 20% year on year last year, into an environment of record prices. So it's great to see government funding being deployed into the upstream and midstream space.
Granted that 2022, the last half of it was certainly bleak, just with the start of the Fed tightening and what that was doing to risky assets and the risky of assets being junior miners. The one standout, though, was Patriot Metals, which just was a rocket ship that happened. And that has some lineage with Pilbara Minerals, with Brisden being on the director. Patriot, of course, focused on the region around James Bay. In another interview, Matt, you said that the market is struggling to value Patriot Metals valuation. Why?
Really, just because of it hadn't published and it still hasn't published any resources. So, the market knows, I think, that it's a big discovery. I think everybody in the industry knows it's a big discovery. But nobody, it's difficult to hang a valuation on because most people will value companies in terms of sort of, certainly at the early stage, in terms of EV per resource ton. You can start thinking about a DCF once you understand sort of the thicknesses of the intercepts, and you can start to model a sort of a pit shape. But really, in the early stages, people are looking at valuing in on an EV to resource ton basis. So when there's no resource, it's very difficult to hang a valuation off it. And a lot of, for instance, Australian companies, they will release an exploration target, so at least you know what you're aiming for. But it's much more difficult to do that on a TSX. So that's what I was pointing to. But that Quebec region, I can name any one of 5 or 6 really exciting projects out there in that sort of northern part of Quebec. Although it does look at this stage as though Patriot is very much the crowning glory of that region.
Lastly, Matt, how do you invest and how do you assess a junior miner company focused on lithium?
Well, it's very difficult. I must say that's a question I get a lot, and I actually wrote something to help people to understand. It's called "How to Invest in Hard Rock Lithium." I wanted to call it "How to Make Money from Hard Rock Lithium," but I thought that was a little bit too racy. But it's available on our website at batterymaterialsreview.com, and it costs the princely sum of £20, which should be available for sorry, should be affordable for most investors. And it goes into really all the things that that I think both experienced and inexperienced investors will need to understand. I talk about drilling results, what they mean, how to interpret them, how to look at feasibility work, how to look at scoping studies, also what to look out for in terms of things like directors' holes and things that, where management teams might be sort of um, uh, trying to pull the wool over your eyes or whatever. So it really is, I think, a good a good report, and it includes really a lot of what I've learned over sort of 20 plus years as a mining analyst and an investor. So hopefully people will find it really useful.
Matt, thank you for your time. I also understand that you're traveling, so we appreciate you making space for us where you're located right now.
I'm in France at the moment, which is why everything's very lilac, lavender colour, really. So apologies to everybody who's looking at my background and going, "Oh, hopefully I haven't made you sick on a weekend afternoon."
Not at all. Lilac Lithium. I thought it was all part of the same theme. Matt, thanks for speaking with Kitco. My name is Michael McCrae. On behalf of Matt Fernley and myself, have a pleasant weekend.